Welcome back to our intermediate financial accounting class. In our last segment, we were talking about taxes, why they're important, how they hit the financial statements, and why we see differences between GAAP and tax numbers. Now that we're comfortable with those basic concepts, it's time to talk a little bit more about what we do to reconcile GAAP numbers and tax numbers. And that leads us immediately from this understanding of income tax basics to the idea of deferred taxes. The basic concept with deferred taxes is the timing difference between GAAP and tax recognition. Remember, we talked last time that GAAP is based on accruals and tax is based on cash, more or less. That's a bit of a simplification, but it works really well. Well, if using accruals, I think that I should be paying more in taxes than I really am this year, then that means that I know later on, as those accruals actually turn into cash, I'm going to have to pay more to the government. And if something I've done this year is going to lead me to owe more in the future, then I have a liability that I need to record. We call that a deferred tax liability. As a really simple example of this, let's imagine that I own an office building and I decide to rent part of it out because I don't need all of the space for my business. So I get contacted by another company. They want to rent my space, but they're a small business and we could have some good synergies together if they grow, but they don't have the cash right now to pay for the building. So I agree to allow them to stay in my building for the next 2 years and make a $50,000 payment at the end of the 2 years. Under GAAP purposes, I record $25,000 worth of revenue this year because I've earned it. And then I would record another $25,000 worth of revenue next year as I wrap up this contract. That's GAAP. For tax purposes, I don't have to pay taxes on a rent revenue like this until I actually get the cash. That's that difference between accrual versus cash. So in looking at my income numbers, I show that I have $25,000 worth of income that I should be taxed on, but I don't actually have to send a check. Well, that means I think my expense should be higher than what I'm sending in this year because my expense is higher than what I'm actually going to pay. I have a difference, $25,000 times my tax rate, that I'm going to have to pay the government next year when I get that actual cash from my customer. That's a deferred tax liability. The other possibility is when it flips, my GAAP income is less than my taxable income. So I actually end up paying more to the government than I think I should have to. So if I prepay taxes, I pay it this year instead of paying it next year when I think I should have to, it's like a prepaid expense, and I show a deferred tax asset. Let's use our same basic example to illustrate deferred tax assets. So let's assume that instead of renting our office space to a small company with no cash flow, we rent to an established company that just likes the location of our office space. They have plenty of money, so instead of paying us at the end of the 2 years, they pay us at the beginning of the 2 years. Well, for GAAP purposes, I still record $25,000 worth of revenue now and $25,000 worth of revenue next year. Now for tax purposes, however, I have to record the whole $50,000 as taxable income now. Well, now what's happening is I'm showing income of 25 and taxable income of 50. And I end up having to pay taxes on much more than I think I should have to under GAAP. That leads to deferred tax asset. I have prepaid on that extra $25,000 worth of revenue. That's deferred tax assets. Now, this is a hard concept for a lot of us as we first get into it. I remember really struggling with this when I first did it. So let's take a look at one more example. Basically, I want to draw you some pictures. Let's put GAAP on this side and tax on this side. Income before taxes for GAAP purposes, let's say, is $200,000. My tax rate is 30%, which leads to $60,000 of income tax expense. And if there's no differences between GAAP and tax rules because we're a small business, then that's it. I'm done. My income tax expense equals what I remit to the government and everything's fine. But as we start filling out our tax return, we realize that under GAAP, I'm using straight line depreciation, but under tax law, I have to use what we call the maker's tables. That's the tax law depreciation method. And under tax law, my depreciation expense is $150,000 higher than it is under GAAP. Well, if I have to add in an extra $150,000 worth of depreciation expense, then my profit is going to drop from $200,000 to $50,000. And I call this taxable income. Again, my tax rate is 30%. So 30% of 50,000 is 15,000. And this is my taxes payable. It's what I actually owe or have paid to the government. Now I look at those two numbers, that difference is my deferred tax. And in this case, since my payable is lower than my expense, I have a deferred tax liability of $45,000. Why? Because I think I should have to pay $60,000 in taxes. I only have to pay $15,000 this year. Later on, I know they're going to make me pay for this depreciation that I took this year, because they're not going to let me keep depreciating forever. Eventually, it's going to catch up to me. That's a deferred tax liability. Now let's take a look at the flip side. Let's say instead of depreciation expense, let's say that I have some unearned revenue. Let me label this. This is depreciation down here. There we go. Let's say I have some unearned revenue. Well, under tax law, you remember we have to pay based on the cash they give us, not on what we earn from a GAAP perspective. So now 200,000 plus 50,000, my taxable income will be $250,000. Again, 30% tax rate. My new tax amount is $75,000. This is taxes payable. And in this case, where I've got the unearned revenue instead of the depreciation, my taxes go up. I end up paying more, $15,000 more in taxes than I think I should have to. But I know later on, I'll already have paid the taxes on that unearned revenue. So when I do get to show up for GAAP purposes, I won't have to pay the tax in the future. Well, if I pay the tax now instead of having to pay it in the future, I have a prepaid expense, and we call that a deferred tax asset. Now we're going to do a lot more examples that deal with deferred taxes and how they work and how we calculate them. But I want you to feel comfortable with the basic concept that if there's a difference between GAAP and tax, then if I have to pay more taxes later because I think my taxable income should be higher than it is, right? My income tax expense is higher than my taxable income. Then I have a deferred tax liability because I'm going to have to pay those taxes in the future. If, on the other hand, I don't think I should have to pay as much in taxes as you say I do, that's a deferred tax asset because I'm prepaying and I'm going to get a tax break later. That idea is one of our key concepts. So please make sure you're comfortable with this idea of what causes deferred taxes, at least on this basic level. And then we'll add details and more exciting calculations as we move on. Now we're going to stop there for this segment. When we come back, we will continue our discussion and keep talking about how we calculate and adjust our income and our balance sheet to show a more accurate income tax expense number and these deferred tax effects. We'll see you then. Thanks.